Hi dear students, welcome back to my session. This is my 10th session which is related to funds flow and cash flow statement followed by accounting standards. So welcome to this Ambedkar, Dr. B.R. Ambedkar Open University for the subject of accounting for management. So in this 10th session, I think you might have gone through your syllabus, course syllabus, and it is unit 15, 16, and also 17, 18. We are going to cover this funds flow, cash flow, followed by accounting standards in this 10th session, right? Be patient and have a pen and paper in your hand. Whatever I'm going to tell you, then you try to record and try to understand. So when it comes to this session, today's session, I think funds flow and cash flow, and these two are like sister documents. Like one is like a funds flow statement is not required legally; it is not a legal obligation. But cash flow statement is a legal obligation. Every company must prepare as per the regulation, right? So let me take about the funds flow statement. What is funds flow statement and how it useful to the company, right? When it comes to the funds means what? Funds means money flow, inflow and outflow. So in a funds flow is a statement. It is a statement that shows that sources means inflow and applications means outflow of funds during the particular accounting period. What are the inflows and outflows that are been happening with the company in the form of flow of funds? So here funds generally means working capital. Funds means working capital. Especially in funds flow statement, we talk more about working capital movement. That is current assets minus current liabilities. As you know, working capital is all about current assets minus current liabilities. It's a day-to-day capital which requires to manage the business operations. So here funds means funds flow statements. Funds means like a working capital. Working capital means current assets minus current liabilities. In a simple definition, if you want to tell about the funds flow statement, it explains how working capital of a business has changed between two accounting periods, right? How working capital between one accounting period to another accounting period, previous working period to this accounting period, how working capital changed. That is moment of the working capital can be recorded here. In a practical example, let us take one example like ABC Limited. When any company you take during the year issued 10 lakh worth of shares, right? So it is a sources of fund. When you issue the shares, is it a fund is coming into organization, going out of the organization? It is when you issue the shares will go to the public, and cash or money will come to the company. So 10 lakh worth of shares is been issued, obtained a bank loan. When you are taking a bank loan, then fund is coming into the organization. 5 lakh worth of bank loan is taken. It is a source of fund. Issue of shares also source of fund. And purchase of machinery. When we buy the machinery, 8 lakh worth of machinery we purchase. Is it application or source of fund? It is application of fund because it is outflow. Fund is going out when we are buying the machinery. And repaid a loan. When we are repaying the loan, the fund is going out. So it is application of fund. So the moment when you see the transaction, you should be able to find whether it is a source or whether it is an application of the fund. So then only the funds flow statement preparation would be very easy. So the funds flow statement summarizes these moments, like inflow and outflow moments can summarize in this funds flow statement. And why significant it is? What is the significance of the funds flow statement? Like simply, if you see the significance of the funds flow statement, it helps in identifying the sources and uses of the funds. I already told you, sources means inflow of the fund, application means outflow of the fund, and identify these sources, inflow and outflow sources, and from where it is coming and to where it is going, the fund. So analyze the changes of working capital, means from one period to another period, how working capital changes, how current liabilities, current assets are been changing from one period to another period can be clearly stated in finance funds flow statement. And evaluate the long-term financial policies, means when you know the funds movement, where it is going more, is it in the form of source or in the form of application, and assist the financial planning. So when fund movement is high, in inflow or outflow source is high, then you can take the certain decisions why the inflow is happening, why outflow is happening. So that's why it assesses the fund management efficiency. So this is what the meaning of or significance of funds flow statement, but it is also has some significant limitations. It has also limitations, like based on the historical information. I already told you that any financial statement is prepared on historical functions and historical transactions only, does not show actual cash movements. It is not showing actual cash movement, but it is showing various assets movements between one period to another period. So it ignores the non-working capital transactions. So majorly the funds flow statement is focusing on working capital movement. So it ignores the capital required transactions, like capital expenditure transactions are ignored in the financial funds flow statement preparation. So not suitable for assessing the short-term liquidity. It is used for the long term, and less useful than cash flow statement in the cash management. So if you really wants to know cash movement and cash management transactions, then you need to prepare a separate cash flow statement. So that's why it is less useful than cash flow statement. More cash flow statement would be more useful than funds flow. So procedure for preparing a funds flow statement. There is a process preparing a funds flow statement. One is preparing the schedule of changes in working capital. I already told you that working capital is all about working capital is funds flow statement is all about working capital management only. So in this process, first step one, you need to prepare a schedule of changes in working capital to prepare a funds flow statement. And step two, you need to calculate the funds from operations from sources to application. You need to prepare sources and application statement. And step three, you need to identify the sources of funds, like issue of shares, long-term borrowing, sale of fixed assets. These are all the sources of funds. And step four, you need to identify application of the funds. Applications means outflow, purchase of fixed assets, redemption of debentures, or repayment of loans, or payment of dividends to the shareholders. All these are all leads to outflow of the fund. So when we purchase the fixed asset is coming and fund will be going out. When we redeem the debentures, when we redeem the debentures, means we are paying back to the investors. We are cancelling the debentures and we are paying back to debenture holders. So the fund is going out, and repayment of loans going out, and repayment of dividends is going out. So fund is going out. These are all been identified as a application of fund. This is the fourth step. First step is prepare a statement of changes in working capital. Second step is calculation of funds from the operations, and third step is identifying the sources of funds, and fourth step is identify the applications of the fund, and fifth one is prepare funds flow statement. This is the clear steps that needs to be followed in funds flow statement. So the proformas and these are all about the theory part only. Just you know what is the purpose and limitations of funds flow statement, how it is useful to the company for managing the funds. So that is about funds flow statement. When it comes to the cash flow statement, I already told you that funds flow and cash flow is a sister and brother statements. Like a cash flow statement, a legal provision is needed, and cash flow statement shows the inflow and outflow of the cash. There we are talking about total working capital in funds flow statement, but in cash flow statement we talk about only the cash movement, right? Only the cash movement, inflow and outflow of the cash, and cash equivalent during the accounting period. That movement only recorded in this statement. So simple definition. It explains, like if you want me to tell a simple definition, it explains how cash is generated and how it is being spent. That is a simple definition of this cash flow statement. What is that? How cash is being generated and how it is being spent. That's what the major objective of the cash flow statement. It helps to assess the cash generating ability of the company, and it is also evaluate the liquidity and solvency of the company, because it is liquidity and solvency is almost connected with the cash only. So it evaluate the liquidity and solvency of the company. It's a plan for the cash requirement, means less cash reserves are there, then where do we procure and how do we procure these less cash reserves? When some company is suffering with the poor cash reserves, then how do we procure it? So it can give the answer, and cash flow statement can give you the answer where to procure and how much funds or how much cash reserves are left with the company. And one more objective or important thing that cash flow statement gives is that improves the cash management. So when we come to know where the cash is going and from where the cash is coming, then that movement can be captured and you can improve the cash management scope. So that's why the scope for cash flow statement is, it is useful for the management, it is useful for the investors, it is useful for the banks, it is useful for the creditors, and it is also useful for the financial analyst, because cash movement makes many people will say that cash is king. When a company has a more cash reserves, means it is a king, like that they may say in the market. But to having a too much cash reserves also not good for the company. Funds become idle without use. So that's why. And cash equivalents, what are the items of cash and cash equivalents? So cash includes cash in hand, cash at bank, and cash equivalents include treasury bills, short term deposits, commercial paper, and other highly liquid instruments like or investments, like typically with a maturity of 3 months or less than 3 months. Maturity documents can be taken as a cash equivalent items. What are those cash equivalent items? Treasury bills, short term deposits, and commercial papers, and other highly liquid investments can be considered as a cash or cash equivalents. Like benefits of preparing a cash flow statement. Generally, when we do prepare a cash flow statement, it shows the actual cash movements, helps in management liquidity, and improves the financial planning and enhances the transparency. When you record from inflow and outflow, it enhances the cash movement and transparency of the cash movement. And presentation of cash flow statement, and how do we prepare? What a cash flow statement consists of? To prepare a cash flow statement, you need to record 3 activities related cash movements. What are those 3 activities related cash movements? Say, for example, operating activities. Operating activities is an activity which is being done for a day-to-day business operations. Say, for example, cash received from customers, cash paid to the suppliers, cash salaries paid, rent paid. These operating related activities or cash related activities must be recorded in operating activities. And one more activity is that investment activities, investing activities. Purchase or sale of long-term assets is an investment activity. Examples: purchase of machinery, sale of land, purchase of investments these are the examples of investment activities. So these related investments, like investment related inflow and outflow, must be recorded, and operating activities, inflow and outflow of cash must be recorded. And last, third activity is called financing activities, which are like transactions affecting the long-term finance. Example, like issue of shares or bank loans or payment of loans or dividend payments. All these activities comes under financing activities. So when you record inflow and outflow of these 3 activities, like operating activities, investment activities, and financing activities, then you will be arrived with the net closing balance of the cash. So that's why to make a cash flow statement, you need to record the cash movement of these 3 operating, investing, and financing activities related information. So this is what the pro forma. Pro forma also includes these three operating and investing and financing activities related information only. So that is what about activities that are being recorded in the cash flow statement. When it comes to the methods of preparing a cash flow statement, there are different methods that are being prepared under cash flow statement. That is, direct method shows the actual cash receipts and payment. That's enough. This is the direct method. It shows only the actual cash receipts and actual cash payments. Examples like cash received from the customer is a direct movement, like and cash paid to the employees, cash paid to the suppliers. So we can use this method for preparing the cash flow statement. Advantage of this direct method preparation of cash flow statement is easy to understand, and actual cash movements are recorded under this direct method. When it comes to the indirect method, it starts with the net profit. And it adjusts for depreciation, gain or loss, sale of assets, changes of working capital. These are all being adjusted with the net profit. So this is the method most commonly used in practice. The indirect method, most of the companies will use. First, they calculate the net profit. Net profit would be adjusted with the depreciation, operating and non-operating activities, and followed by investment activities, followed by financing activities, would be adjusted to the net profit, so that finally you will be arrived with the closing cash balance of the business. So to prepare a cash flow statement, there are two methods: direct method and indirect methods. So let us take the difference between funds flow statement and cash flow statement. When it comes to preparation funds flow statement, our focus is, I already told you that in the session, that cash flow statement focus is changes in the working capital. Funds flow statement focus is changes in the working capital only, but cash flow statement focus is changes in the cash and changes cash equivalents. So only cash component would be considered in cash flow statement. Funds flow statement would be considered only changes of working capital and funds movement. And purpose is for long-term financial analysis is useful in funds flow statement. And purpose of cash flow statement is short-term cash management would be useful. And basis for working capital is basis for funds flow statement is working capital, and basis for cash flow statement is cash. And liquidity. Liquidity in terms of funds flow statement is very less useful, and in terms of cash flow statement, liquidity is more useful because it relates with the cash movement. So standards, any legal obligations are there for funds flow statement? No. Longer mandatory, I think no longer mandatory under many reporting frameworks, but cash flow statement is required a legal obligation and under the accounting standards. So that's why the key takeaways from this funds flow cash flow statement is funds flow statement summary. Let's take the summary of this funds flow and cash flow summary. If we take funds flow statement, shows the funds movement of the funds, that is working capital, and sources of the funds, issues of shares, loans, sale of fixed assets is the sources of fund, uses of funds, that is application of fund is purchase of assets, loan repayment. All these are all applications or uses of funds. Cash flow statement shows the inflow and outflow of the cash movement, and cash flows are prepared with the three major activities, that is operating activities, investment activities, and financing activities. These are the three major activities considered in preparing the cash flow statement. Methods of preparing cash flow statement is direct method and indirect method, where in direct method all the cash movements are recorded, inflow and outflow. In indirect method, all the cash movements are adjusted with net profit. Net profit would be adjusted with many adjustments with operating, investment, and financing activities. So these are the two methods that are been there with operating and non-operating expenditures. So that is about funds flow and cash flow statements which are there. So when it comes to this accounting standards, that is about a funds flow statement and all cash flow statement. Now let us come to this accounting standards and Indian accounting standards. Like what is the AS and Ind AS, right? So let us talk about this introduction of this accounting standard. Let us begin with suppose two students write the same examinations, but one answers in English and other answers in Telugu. Can we compare them easily? I think probably not. Because similarly, if the companies prepare the financial statements with or by using different accounting methods, comparison becomes difficult, right? Like think two accounting policies cannot be applied for different companies. So if you want to compare one company with another company, where the companies are maintaining different accounting policies, it is becoming very difficult to compare with the two companies. That's why we need accounting standards which are commonly used globally, commonly used in global. So accounting standards provide a common language for preparing a financial statements. So meaning of accounting standards, I think accounting standards are written guidelines which are been issued by recognized accounting bodies that prescribes the principles and methods preparing the presenting the financial statements. And simple meaning that they are the rules of accounting, right? That ensures that financial statements are prepared consistently, uniformly, transformly. So let us take the objectives of accounting standard. It ensures that uniformity of accounting practices, because Tata company, if we take a Tata company is there in India and other 140 countries, the Tata company is running. So if they don't have a unique or uniform accounting policies, it is difficult for them to prepare accounting reports or financial statements which are commonly useful for every investor in the globe. So that's why, to attract or to give a clear picture, a global picture, so many Indian AIS, Indian accounting standards, India AIS are compared or mingled with the IFRS, International Financial Reporting Standards. So that's what IFRS and India is very close by. So that's why the company which is running with a multinational activity can be used this IFRS or India as guidelines or accounting policies to prepare to manage their accounting practices and preparing of their financial statements, right? So let us see objectives of accounting standards. I already told you, it ensures that uniformity in accounting practices and improves the capability between two companies, and comparison becomes very easy, and the reliability of the financial statement would become very easy, and promote the transparency and fairness, because one accounting rule, every accounting practice, say for example depreciation method like a straight line method or written down value method or units of production method. These three are recognized depreciation or accounting practice, and companies can follow any one of these method. Irrespective of any many methods are there, but these are the recognized methods. So like this, IFRS allows some method and India allows some other methods. So that's why uniform methods must be there to compare the companies easy way. And benefits of accounting standards. Why accounting standards must be uniform globally means uniformity, comparability, and reliability, transparency, investor confidence, and better financial decisions. These are the various qualities or benefits of the accounting standards that are there in the globe to maintain comparability, to maintain the reliability, transparency, to get the investor confidence. The globally they are releasing the same accounting standards which are being followed by many accounting or multinational companies. And not only that benefits and qualities, but also there are some limitations of accounting standards under which, although useful for accounting standards, we have some of the limitations. They can't be cover every business situation. Means small businesses cannot be afford this IFRS, like MSME companies. MSME companies, if we take, they cannot afford these international policies or international accounting policies, and frequent amendments required continuous updates. I think these IFRS boards and Indian AS are linked together. So in globe, many updates and frequent amendments are taking place by the many governments. So that's why frequent changes and updates are needed in your accounting practices. So that is what one other limitation of this accounting standard. And some standards required professional judgment. Professional judgments, you need to have professional accounting practitioners to settle down these accounting policies, to implement these accounting policies. You need professional bodies or professionally managed accounting personalities. So they reduce the flexibility and in certain situations, like flexibility, they reduce the flexibility. See, I'm interested in other accounting practice, but I cannot implement it because it has been standardized and it has been implemented by international bodies. So that's why we should have a common goal. So that's why flexible accounting rules cannot be applied when they are introduced globally. So ASB, what is ASB? ASB is Accounting Standard Board. In India, ASB is responsible to constitute these accounting policies, and Accounting Standard Board is a body constituted by ICAI to formulate the accounting standards in India. Objectives of Accounting Standard Board is, when it comes to the objectives, develop the accounting standards, number one objective of accounting standard board, and improve the accounting practices every year, and promote the harmonization and international standards, and ensure that quality financial reporting is happening. So that is what the major objectives of accounting standard board, ASB, who is responsible in India to frame the accounting standards and accounting procedures. And the functions of ASB is that formulate the accounting standards. I already told you, recommended every improvements in every year, and they consult the regulators, industry, and professionals based on their requirement. They do change their accounting practices and accounting rules and accounting standards based on the industry requirement and based on the professional requirement and based on the regulatory requirement. They try to keep on change the accounting standards, and it assisted in convergence in global standards. Once they have been setting up with a standard with a global manner, so it becomes a global standard. So that's why it is very essential. The list of some of the example of accounting standard, if you see, AS1, accounting standard 1 is talking about a disclosure of accounting policies, and AS2 is talking about valuation of inventories, AS3 cash flow statement, and AS10 is property and plant equipment, and AS11 effects of changes in foreign exchange rates, and AS15 employee benefits, and AS29 is talking about provisions and contingent liabilities and contingent assets. So like this, these are the some of the examples of accounting standards. So by which I think you have been enjoying this session. I think you have got enough relating to these accounting standards and funds flow statement and cash flow statement. I tried my level best to give you best session and best input regarding these concepts. Thank you. Happy learning, and we'll continue these sessions in the future time. Thank you for patient listening. Thank you, everyone.